Tune in to the Real Estate Roundup with the River Counties Association of Realtors. Join us every Saturday at 8:30 a.m. on the Mix 104.1 as we explore the latest in real estate. Whether you're buying, selling, or just love real estate, don't miss our expert advice and exclusive insights. So grab a cup of coffee, sit back, and let's explore the dynamic world of real estate in our vibrant River Counties community. Catch Real Estate Roundup and make your property dreams a reality.
Hi, and welcome to River Counties Real Estate Talk. And I am here today joined by Michelle Tennyson with Highlands Residential Mortgage. And we're going to talk about everything to do with buying and financing a house. Hello, Michelle.
Hey, Lisa.
It's good to have you. Would you go ahead and share your contact information with us?
Yes, I would be happy to. I am Michelle Tennyson with Highlands Residential Mortgage. You can reach me anytime on my cell phone at 423-316-3411. And we are located in Chattanooga and would love to help you if you need a mortgage.
All right, fantastic. So, mortgages are kind of like this mystery thing that you have to have 95% of the time. You got to have a mortgage if you're going to buy a house.
Correct.
And so today we're just going to kind of break down some of the simple science behind a mortgage. And so one of the things that I get asked a lot that people don't necessarily understand is, so I can go to my local bank and I can get a mortgage at my local bank.
Yes.
And, but I think that the consumer out there sometimes gets confused about that the bank is the only place that you can go. So what do you tell people is the difference between going to the bank you bank at or coming to a mortgage broker like yourself?
Well, the big difference is at a mortgage broker, mortgages are all we do. So therefore, that's all we focus on. That's all we do 24/7. And therefore, we have a larger array of mortgages, first of all.
Okay.
And because that's all we do, we have the system down pat. We can close a loan in 2 weeks if we need to do so.
Wow.
Typically, most other people aren't ready to do that with the whole transaction and the whole process, but we can. 7 days is the minimum because guidelines require you disclose and can't close for at least 7 days. But we can do that if we have to. We've saved deals from other lenders that couldn't get things done, and we were able to close in 7 days from the day we disclose.
Yeah, I've seen you guys pull some magic tricks and get things closed super fast, which is awesome, especially if you're in a situation where you're selling a house and then buying a house, and maybe something happened with the first house you were going to purchase and it fell through for inspection reasons, and you've got yours under contract, and now you're on a strict deadline because the other people want to buy and close. And so maybe you might only have 2 weeks left before that closing and you got to hurry. And so it is nice when you have a lender that can do things in a fast time frame.
Yes, I agree. And that's one of the things that we are well known for is closing on time every time and closing early if we need to do that.
Fantastic.
So many of times I've had a loan cleared to close and ready to go, and we're just sitting waiting a week ahead for closing to happen because they had a house to sell and it's not ready or other factors, and they need to wait until closing date.
Sure.
So that's one thing. And I feel like that's one thing we as mortgage brokers can definitely do over and above banks. They have so many other focuses going on in a bank that they don't focus strictly on their mortgages. And that's all we do. So we have that advantage. Plus, banks, a lot of times, are a little more limited on their programs that they offer.
Okay.
They have certain things that they are great for, but then there's other things that they're not as lenient on because that isn't their primary focus.
Sure.
We're more lenient. We have more options for different loan programs that a lot of banks won't have.
Okay. Tell me about different loan programs. Let's just, we have the normal, if you want to call it that, things that most people know about, which is your conventional loan, which by the name of it is the one that people may refer to the most. It's just that typical buyer, and they can do that program. And so if I'm ready to buy and I'm looking at a conventional loan, is there any advantage for me as a buyer to using a conventional loan versus a FHA type loan?
It's going to depend. There are, depending on the borrower. And that's the thing. Everyone doesn't fit in a specific hole. So you have to look at that individual borrower and their specific needs. If you have someone that has high credit scores with more money to put down, then the conventional is definitely going to be their way, because they're going to have lower mortgage insurance premiums with a higher credit score. Because on any conventional loan, on any loan, unless you pay 20% down, you're going to have to pay mortgage insurance.
And that mortgage insurance is pretty much insuring the bank that if you default, their money's going to come to them.
Correct.
Okay.
Correct. You're paying them to insure to the bank that if you default, they will make that payment, they pay off the mortgage to the bank, and then they go through the foreclosure process and getting their money back.
Sure.
So yes, there's mortgage insurance on any of the government loans, and also on a conventional loan. But then on a conventional loan, it's tiered based on your loan to value and your credit scores. So that's why sometimes you have, say, first time home buyers that maybe don't have as much credit, so their credit scores aren't as great yet. Sometimes we look at an FHA loan because they would have a higher mortgage insurance premium going conventional versus going FHA.
Okay.
Because FHA only has one set mortgage insurance premium across the board, no matter what your credit score is.
Okay.
So that's why it really depends on the borrower. Their credit score makes a huge difference, and then how much money they have to put down.
Sure.
If you have, say, 10% down, you're not quite at the 20%, but you have 10%, we may still be better off to go conventional, even with a lower credit score, because there again, the mortgage insurance, the interest rate on the loan, everything is tiered based on that loan to value. Okay. So even at 10%, you're going to get a better MI rate than at 95%.
Okay.
Et cetera. So.
Yeah, so it's not a one size fits all when it comes to mortgages. And a lot of times I think there's a misconception out there with sellers to understand that because I, as a buyer, may come to the table and have an FHA loan or a VA loan or a USDA loan, it doesn't mean that I don't make enough money or I have bad credit and that I'm a risk. And I think that sometimes people need to hear that message a little louder, because, right now in a market where we have higher interest rates, people are they're going to pick the program that's going to give them the best interest rate and the best all around fit than to just go, okay, well, because I have higher credit and because I have more to put down, I'm just going to go for the conventional. I think they're going to pick. Is that what you're seeing, so that people can kind of, have an option with choices?
Correct. I mean, even if you do have the higher credit score and, put a little bit more money down, sometimes, depending on the reasons, FHA may still be better. The interest rates fluctuate with every loan program, and so sometimes when we run everything, FHA may give us a better rate than conventional, and it is the rate. Everybody's looking at the rate right now because there's so much discussion on the rate, even though rates are great, in my opinion. If you look at a 50-year history, the average interest rates are 6 and 7%. So that is where overall in history your rates are going to stay. We did get a little spoiled when we got down to 2 and 3 and 4s, but rates in 6s, which is where we are good interest rates. So it's still a great time to buy right now. And in fact, for everyone out there listening, don't sit there and wait thinking, oh, my interest rate's going to come down and I'll wait 6 more months. 6 more months, when that rate comes down, everyone is going to be out there wanting to buy. Then they're all going to be competing to get that same house that you want. But right now, there's not as many people out there, so you can go buy that house and you can probably get some seller concessions, meaning you can ask them to pay closing costs. You can ask them to pay discount points to get a lower rate. You can do all these things right now because the sellers want to sell their house. But in 6 months, when the rates hopefully maybe do drop, everybody's going to hit the market. You're not going to have that weapon to use, because the seller then is going to say, oh, no, I've got 2 other offers coming in. I'm not going to pay anything for you. In fact, I want the price of my house to go up. So
that's right.
If you want it, you're going to pay more.
And we say it over and over and over again. As a real estate agent, I don't have a crystal ball. As a lender, you don't have a crystal ball. We cannot tell you what's going to happen in 6 months. But what I can tell you is what's happening right now, and what I can see right now. And there are people out there that are still saying, I'm going to wait for the crash. I'm going to wait for the crash. I'm going to wait for the crash. Now, were you in the mortgage industry when we had the first crash?
Oh, yes.
Yes.
I've been doing this 32 years this year, so I've lived through a lot. And that's why I'm saying 6% rates are really good.
Yes. It's not double digits.
No, exactly.
And our parents were paying double digits when they bought their houses. And so what was different when that crash happened? What was different in the mortgage industry then than what is here now that kind of gives you the faith that we're not headed towards a crash?
I don't think we are. Back then, there were so many loans that were going on that as a loan officer, I mean, I personally didn't do several of the loans that I'm talking about, but they were loans where people could just come in and say stated income. You would state your income to be whatever it was. Even if you're a W-2 paid employee, meaning W-2s, you know your income is roughly going to be this every year.
Right.
But if you had a high enough credit score, you could come in and state your income. You could state it to be double what it was and then get qualified to buy a lot more than what you really should have been qualified for. Well, eventually that's going to catch up to you.
It will.
So therefore, those kind of programs do not exist anymore. There's so many new guidelines that come out after 2008 that were set in place to protect the industry against that. So no, I do not foresee anything like we had back then. That's just not going to happen. They've set it up. Well, I mean, we had some loans that were 105%. You know, you got more. I mean, stated income loans, 105%. Some of those programs,
you could basically be breathing, walk in the door, and you'd get a set of keys handed to you.
Correct. And that's not happening now. That's not going to happen. So the crash that we had back then, no one foresees that happening again at this point.
Yes, the climate is not ripe for it.
No.
And I think that, you know, just like I said a minute ago, if we can have buyers that'll say, I'm just going to sit on it and I'm just going to wait. Mm-hmm. The longer you wait, the longer you're given an opportunity for there to be negative changes that could drastically impact your buying power. And that's, you know, if you know that you're going to be getting a big promotion and you know you're getting that in the next 3 months, it's going to increase your income and it's going to put you in a different position to where you might be able to buy more house, and that's what your goal is. Should they call you now and start talking about that now, or wait until they've gotten that promotion and they're where they're going to be and start talking to you then?
No, I would definitely recommend going ahead and calling and let us look at everything, because there's a chance. We can even do now what's called a soft pull credit. So when we pull a soft pull credit, it does not hit your credit. So we can at least look at your credit and make sure it's where it needs to be. Even if you have good credit, 3 months from now, we can look at it and set you up to where you have the peak, the best credit you can have in 3 months from now. So we can go ahead and look and see what you can get approved for now, what you can get approved for in 3 months when you get that raise. But also we can look at your credit, and I can see where, you know, maybe you have a 700 credit score, but we can look at your credit and say, oh, wait, you can do this, and you can get yourself to a 780 credit score, which is like the highest tier. So we can go ahead and get you set up to where you're in the very best position for buying in 3 months. But those are things that take time, improving credit scores.
Yes.
And again, improving credit scores can help mortgage insurance and interest rates. Even if you are at a good credit score now, why not try to get the very best score that you can get? And the other thing is, something I thought about when you were talking about people waiting. Say people a year ago was like, I'm going to wait. How much was that house that they wanted a year ago versus right now?
Absolutely.
So that's the only bad thing about waiting is prices have only been going up on houses. So waiting, even though you may get a little bit better interest rate, your price on your home just went up. So that kind of just negated that better rate. I mean, it might have been 0.5% better rate, but your price just went up. So
yes, absolutely.
In my opinion, waiting makes everything cost you more in the long run.
It does. It
Because
really
you can
does.
always refinance later when the rates do come down and improve. But as long as you have your home and you've got it locked in at that price, you can refinance and get a lower rate at a later date.
Yes, you can. Yes, you can. My name is Lisa Calfee, and I am licensed real estate agent in Tennessee and Georgia, and would love to be your agent of choice. Lisa Calfee, your favorite Tennessee, North Georgia realtor with the Source Real Estate Group. You can reach me at 423-802-0875. So what are you seeing right now as a challenge for people when they are trying to purchase a house? Like, what are the challenges that you feel like the first time buyers are really facing right now?
The biggest challenge is just being able to afford something.
Sure.
You really, these days, first time buyers especially, almost have to have two incomes with minimal debt to be able to buy in some of the price ranges that we're looking at.
Sure.
But that's why it's good to go ahead and get everything checked out, because it may be that you have one small car payment that might take you 5 months to get it paid off, but we can go ahead and know ahead of time that that's going to make a huge difference in your buying power. And so we can go ahead and get you set up so you know that, work on getting that car paid off, and then that could qualify you to buy a lot nicer home by taking care of that one little debt. So it's never too early to check to see what you can qualify for.
Absolutely. And, the lingering thing, I have 3 grown children, and that they're in that stage of life where they've gone to college and they're looking at making their first purchase, and there's that student debt that's hanging over their head. So the $1 million question is, do they have to count that as a debt if it's been deferred? And how does all that stack up when a young person who's, finished college and now has that student debt to deal with? How does that play into what has to be counted towards what is their debt to income ratio?
Well, sadly, we do have to count all student loans, no matter if they're deferred, not deferred, we have to count. But that's where the different loan programs sometimes come into play. For instance, on a conventional loan, we have to count 1% of whatever the loan balance is. But on a FHA loan, we only have to count 0.5% of what the loan balance is. So even if they're not making payments, we still have to count, because they know that they will be making payments at some point,
Right.
or should. So therefore, we are now required to count payments against them regardless of anything.
So you're not actually counting the actual payment. You're taking a percentage of the entire balance?
Well, it does depend. If there is a payment set
Okay.
in there already, again, it kind of varies with the loan program, but if there is already a payment set scheduled on the credit report, then we do have to take that payment. But a lot of student loans that have been deferred show 0 for the payment.
Okay, yes.
So when there is a 0 payment in there, that's when we have to either take 1% or 0.5% of that loan balance, and that's what we make the payment.
Okay. And it's one of those things, and congratulations on getting an education. And, we know that higher education is quite expensive now. And so it's workable.
Yes,
That's the
definitely.
other reason why you have a conversation directly with the lender, so that the lender can take you through that process. And so whenever I get ready to start working with a buyer, one of my initial questions is going to be, have you spoken with a lender, and have you been through the pre-approval process? Because it's important to know what kind of loan that you're going to be getting, because there are certain requirements for the home based on the type of loan that they're getting. We run into little things that are, if they're going to buy a condo, and let's say that there's a whole specific thing where they can't have a certain kind of loan in that condominium complex based on the makeup of the complex.
Correct.
And so you can run into some issues there. So if you're an FHA buyer, then I have to be real careful about where you're looking for a condo. If a condo is what you're after, we got to check on those things.
Correct.
And then if you are going to buy FHA, it needs to meet a certain condition criteria.
Correct.
So talking with the lender is the first thing that I want them to do, because you can get online and look at a calculator all day long, plug your own numbers in and think, oh, look, I can afford this payment, and that translates into this amount of a home. And then when they talk to the lender, it's not the same, because they didn't really plug in all the numbers, and it really wasn't giving them the clear picture. And I've seen it happen a lot.
Yes.
And then we don't want to go look at a $400,000 house if your buying power is $300,000, because I don't want you to fall in love with a $400,000 house and be so disappointed.
Yeah, it makes it a harder search down the road if you're not prepared and know exactly what you're looking for. And that's what we try to look at ahead of time. Like, okay, here's the very max that you can get. That means if the tax, there's been where some people are so borderline, it's like, but just know, if you find a property and the taxes are doubled, say it's in the city and the county, taxes double, that might make your payment go up just enough to where you wouldn't qualify at a certain level. Or if it is in a neighborhood that requires an HOA, a homeowners association fee, then that's something else you have to look at that they probably didn't think about and didn't plug in that debt ratio. So it's always good to talk to a lender, because we think ahead of those things, because probably at some point in time that bug has bit us.
Yes.
And we now know, learning the hard way, that we want to watch out if there's a HOA, or if we've been estimating taxes. When we don't have a property, we have to estimate taxes and insurance. But I do tell my customers, this is what I'm estimating, but if you find a property that has city and county taxes, that may double. That may make this number change a little bit. So I like to let them know if they are on that borderline of the debt ratio qualifying. I like to let them know that, just so they don't push the limit too much.
Absolutely.
To give us a little leeway when we run into those kind of things.
And I never want a buyer to push themselves to the max so that they are house poor. Mm-hmm. I think being responsible fiscally is important, and obviously I can't control what decisions that they ultimately make, but I also want them to really think long and hard about is this comfortable?
Mm-hmm.
Because we all know that once you buy a home, things change with taxes and insurance, and your payment does go up over time just because of that escrow account.
Yes.
And so if you were pushed to the max, and then in a year you aren't making more money and that payment goes up, don't want you to be so strapped to a house that all you have to show for all your hard work is just a house. You don't get to enjoy things.
Correct.
And so is it possible to buy a house when you are a self-employed person?
Yes, you most definitely can. But there again, that is definitely 100% one of the ones that we want to look at ahead of time, because we have to look at tax returns. And my husband's self-employed, so I know how it is. You want to write off every expense you can, so that's a little less taxes you're paying at tax season. So I 100% get that, and I'm 100% all about doing that. However, when you were wanting to buy a home, that can really bite you, because therefore, we do have to take what is on those tax returns, minus all those write-offs. The only income we can add back in is depreciation, because that's not a true net expense. So if there's anything in your depreciation line, that can be added back to your bottom line net off your tax returns. So it's really good, especially if you're self-employed. And also, just FYI, self-employed, you have to be self-employed with 2 years tax returns. We have to have a complete 2 years tax returns to be able to count that income period. Now, if for some reason you had been, say, W-2'd and maybe paid by an employer, but then you went out on your own and you did the same line of work. So there is a chance, as long as you have one complete tax return self-employed, because you did that same type of work previously, there is a chance, not a guarantee, that we could still use that income, but we would at least have to have the one tax return. Again, typically they always want the 2 complete years when you're self-employed.
Sure. And as real estate agents, we are in that same boat.
Yes.
We totally understand that. And you really do try your hardest to write things off. And we have a lot of expenses that are, legitimately write-offs. but at the same time, it can really bite you because then your buying power goes down when it comes to time to really buy something. Do you all have loans for second homes? Be that a let's just say a vacation home type thing, or if you're going to do an investment and buy a rental home, do you have loans for that type of?
Yes, we can do all of that. Second homes, vacation homes, we can do those pretty much anytime. And same thing with investment property. As long as you have more capital, typically on investment property, you're going to need at least 25% down to be able to get a good interest rate for investment property.
Sure.
So yes, we can do all of those type of loans. Pretty much any kind of loan out there, we can do that.
Okay.
So we have we have a one-time closed construction loan. And of course we do all of the government loans, USDA, VA, FHA. So we can do all of those, any conventional loan. So we have a very large array of loan options for our clients.
So when you say a one-time closed construction loan, does that mean if I'm going to go out and buy a lot or land, and then I'm going to build on it, that can all be in one loan?
Correct.
Okay.
You can finance all that into one loan, and we actually can do a construction loan, conventional or FHA these days. So that's great. You close it up front. We set up your construction loan, and then when the construction is complete, we convert that loan into a fixed 30-year mortgage. So it's a great, and you have a one-time option to, if rates have dropped from the time we started with your construction loan to the time that you're completed and you're ready to lock into the 30-year fixed rate program, you can drop that interest rate one time throughout that construction process to a lower rate if rates do drop.
That's really nice because it might be a year with building, and a lot can change in a year's time.
Correct.
That's fantastic. And what are some of the biggest things that you warn people of when they're preparing to buy a home or started the process that can really mess the whole thing up? I mean, we always joke about, please do not go buy a brand new car when we've already started the mortgage process. But what other things do you see happen that can really mess up the buying process?
The biggest thing that I like to tell folks is, like you said, do not go buy anything. Do not go, don't even let anyone inquire on your credit. Because just inquiries can hit your credit, and that can adjust your score, and then do not deposit cash. Cash is a 4-letter word in the mortgage business. We can't count any kind of cash that gets deposited in your account, so just do not deposit cash.
Yeah, don't keep it in the mattress in a brown paper bag and then go to the bank with it. That is definitely something.
Yes, that
can really mess you up.
We cannot count if you have large amounts of money of cash in a safe at home and you're wanting to buy in the next 3 months, go deposit it right now.
Right.
It takes 2 months to be in your account for it to be considered seasoned.
Okay.
And then it's good.
Okay.
But don't deposit cash. Don't do anything on your credit. Don't let anyone check your credit. Don't buy anything new.
And don't quit your job.
Don't charge up a credit card. And don't quit your job.
Yes.
Sadly, I've got one right now in the seller or the buyer buying their home lost their job a week before closing.
Awful.
It's devastating, and I hate it.
Well, it has been wonderful for you to share all your insight about mortgage, and we appreciate you being here. Share your contact information one more time.
Okay. Thanks for having me. I appreciate it. It was great. Again, it's Michelle Tennyson with Highlands Residential Mortgage. You can reach me anytime at 423-316-3411. Have a great day.
And I'm Lisa Calfee, 423-802-0875, your favorite Tennessee, North Georgia realtor.
Do you imagine a career with flexibility and limitless income potential? It's possible by becoming a realtor. The River Counties Association of Realtors, located right here in Cleveland, Tennessee, is ready to help you unlock your potential. We're your go-to resource for guiding you to obtain your Tennessee real estate license. We're more than just realtors. We're a vital part of our community. Partnering with local charities, we work tirelessly to make a difference. Join the River Counties Association of Realtors today, where your career can thrive and community can too. Visit rivercounties.com or call 476-5912. Your new path awaits.